Teşekkür ederiz Hande. Charlie, thank you so much for coming. Today is about non-farm payrolls and unemployment, right?
Yep, absolutely.
So unemployment went to 5.8 unexpectedly, 6-year low.
Yep.
But the non-farm payroll wasn't so high as expected. Do you like the numbers? Because the stock market doesn't seem to like it.
The stock market's roughly flat here, so it's not really moving much in either direction. But the numbers overall are continuing in the pace of economic expansion. We're seeing roughly 200,000 jobs average most of this year. What really is the interesting thing is that the bond market really isn't buying into a continued growth expansion here. So what I mean by that is if you look at the income gains, you're only at 0.1% last month and 2% year over year. So it's not really an inflationary type of read for the markets. But in terms of jobs, the economy is healing. Things are getting better. That's good news for the markets, but now the focus shifts to the Fed, and when will the Fed move, and will they move faster than expected now that the unemployment rate continues to go down? And now this is the longest period of positive job gains in the monthly payroll report in history, actually. So for the Fed to ignore these positive numbers for much longer will be very difficult, in my view.
So you're saying there's no wage inflation, no wage growth. That is the downside of this, in addition to the non-farm payroll.
Correct.
So, but we've been seeing a shift in the dollar, right? The dollarization, can we call that?
Yeah.
So how long will it take for the U.S. dollar an upside trend?
So this is a really strong move that we've been seeing in the dollar over the last few months. It's very extreme from an historical perspective, and it's really a shift from the environment that was persisting from '08 to really last year, where a stronger dollar was viewed as a negative. It was viewed as a risk-off type of precedent for the markets. Now a stronger dollar is kind of shifting. It's being viewed as positive for the U.S. and for the U.S. economy. Now at a certain point, that's going to become a problem because 50% of the revenues in the S&P 500 companies come from overseas, and a strong dollar is going to hurt them. So it's a very interesting dynamic worldwide where you have the third largest economy in Japan who's telling you they want to crash their currency. You have the ECB, who also is trying to drive the euro lower, and it's a zero-sum game, these currency wars. So they're trying to take share in terms of exports, boost their exports. Now someone's going to get hurt by that, and we'll see how that plays out, but it's going to be an important dynamic in markets for the next year.
Yeah, talking about Japan, right? You said that was an interesting, by the way, surprise with Japan's additional stimulus. And yesterday, Mario Draghi followed his line,
right?
Because they Standard & Poor's.
Yep.
Are we going to keep seeing more of these kind of behavior from the global central bankers?
I think so, because you have a slowing global growth backdrop. The pie is shrinking. So how do these countries generate growth? They don't have the underlying fundamentals that aren't there. So they're trying to use financial engineering to generate growth. And so they're trying to weaken their currencies, boost exports. They're trying to increase their stock markets, and hopefully that will lead to a wealth effect, as we have said here. The problem is we just haven't seen it yet, right? There has been no wealth effect in Japan. There has been no wealth effect yet in Europe, and same thing in the U.S. So it's leading to greater disparity in the wealth of countries. You have a huge disparity between the rich and the poor. We're talking about wage growth. The average person just isn't participating, but the stock market seems to love this type of behavior, at least for now.
Well, you said the U.S. economy is like the global economy, but we have been receiving the economic data, which is somehow on the more positive side, we would say, right?
Certainly in the U.S., yeah.
So do you think the U.S. economy would differentiate? Is it sufficient enough to endure, to resist all the global slowdown?
Yeah.
Coming from China and Europe.
Right. It might be enough to keep, the U.S. economy might be strong enough to keep it out of recession, but it's not going to be immune if Europe goes back into another recession. It looks like it might be doing now. If Japan goes back into another recession, China has the slowest growth since 2009. It's going to feel those effects because we're a global economy now, and the U.S. is not going to be immune to that. So there's a difference between the stock market and the economy, but the U.S. economy is going to feel that at some point.
It's funny that you said there's a difference between the economy and the stock market. However, they still follow each other. Even the politics, we had the elections that caused a rally on Wednesday, and then Thursday we had the ECB. So, the strong dollar right now, how will strong dollar affect U.S. economic policy? Because I just want to ask you, does it make U.S. economy uncomfortable to hear from these?
Well, again, at a certain point, it might. But a strong dollar, historically, this is a new paradigm where a strong currency is viewed as negative. In the history of the world, most of the time, you want a strong currency. So this notion that with Japan that they're trying to deliberately crash their currency, that's an outlier in terms of what you really strive for. So the 90s, we had a very strong dollar in the U.S. That was good for the U.S. The economic growth was good.
Right.
Wage growth was good back then. That would be a great underlying backdrop. Now, a strong dollar, because the euro and the yen are crashing, now that's a different story. That may not be so much because the U.S. is so strong. It's just that everyone else is so weak and everyone else is manipulating their currency. So it's going to be difficult to differentiate between those two factors.
Let's come to the Fed, because you said it is now the question about the interest rates, right? When are they, and if they are going to raise it.
The market's obsessed with that when they're going to.
Thank you. What is that so obsession about? Is that important? And when do you think the Fed is going to raise the interest?
Right. Well, it's just an important from a psychological standpoint, right? Everyone's been so comforted by the fact that interest rates have been at 0% now for it'll be 6 years next month, and it's hard to believe. Now, in the history of the Fed, they've never kept rates at a low level for even a year. Now we're 6 years into it. So what it's created is a psychological backdrop where as long as the Fed is keeping rates low, then they're telling you you should take risks, you should take more risks. So people are obsessed by it because we've had these enormous gains in markets, and they're worried that when the Fed starts shifting policy, well, we're going to give some of that back. So that's why you're hypersensitive. As for when they're going to move, the futures market is predicting the first move will be in September of 2015. So that's what they're saying. So it's still almost another year of 0%. It was as early as the first quarter of next year, but we had this recent correction in the S&P, and the Fed start coming out with more dovish talk, and the expectations shifted. So it's very much market and data dependent. If the market continues to rally, they'll probably raise rates sooner. If the market falters, they might never raise rates, which is really, what some people are predicting.
That's a very good point. Thank you so much. Our time is up, but we'll have you again. I like the way you said that the market seems to be obsessed. That's so true. Thank you for coming again.
Good to be with you.
Sohbetimiz burada sona erdi. Fed, bugünkü tarım dışı istihdam, onun ekonomiye, borsaya etkisi ve faizler. Bunlarla birlikte Cuma'ydı. Bugün de tamamlamış olduk diyorum. İyi hafta sonları diliyorum. Hande, söz tekrar sizde İstanbul'da.